What is financial planning? Well, there's essentially two paths that your life is going to take from a financial perspective. You're either going to be able to afford to do everything you want in life and die with at least $1 in your bank account or whatever target amount you want to leave to your kids. Or door number two is you're going to miss out on doing things that you want in life. You're going to have a financial life whether you take charge of it or not. And whether you get to do everything depends on a lot of things. But the one way I know you can make it more likely to achieve door number one is through planning, through actually being honest with yourself about what's realistic, coming up with your own goals and objectives, and doing the things that are most likely to get you there. There's no guarantee in life, but doing the things that are most likely to get you there. Now, the difference between a plan and planning is that you want a plan that lives and breathes. Planning is a verb. That's something we have to do going forward. So what I like to do is build a financial model for my clients' lives, project it all the way out to the end, realize that's not going to be the exact case of what you're going to experience, but use that as life changes to show how the changes reflect in the model so we can understand what the decisions we're making today, how they affect us in our 60s, 70s, and 80s. The real risk over the long run is not having enough money specifically or making investment mistakes, although those are risks. The real risk is inflation. At a 3% inflation rate, something that costs $1 today is going to cost $2.50 30 years from now. Now, you may say, well, 30 years is a long time. Yeah, but if you retire at age 65 and you live to age 95, guess what? That's 30 years and everything costs 2.5 times as much at a 3% inflation rate. Of course, inflation could be higher or lower. That's the real risk we're defending against. So if you feel like you have a lot of money or you're projected to have a lot of money and you feel like you're gonna have plenty of money to retire, make sure and check that against the inflation of the costs that you have in your own life going forward. We're going to talk a little bit about that going forward. On the flip side of this, what a lot of people think is doing the safe thing, keeping money in a checking account or investing in very low risk investments, that can actually increase the risk of door number two, where you don't get to do the things that you want to do. So safety, quote unquote, safe investments may actually be increasing the risk in terms of your overall life's objectives. Now, when I do financial planning, this is the way that I look at it. There's 4 areas of your financial life. We want to protect what we have. That's insurance. So property and casualty insurance, life insurance, all of that good stuff. There's knowing where it goes. That's spending. Spending is important. We can never get away from that. You should know the cost of your lifestyle because that's the cost that you need to meet every year the rest of your life. And if you don't know what that number is, you really should take a look at that. Make it grow. That's your investment strategy. That's the engine that drives the growth in your wealth. Early on, the engine is your earnings and your savings, your propensity to save, put money aside. But as those savings grow and you get compounding on those investments, the investments really take over somewhere in your 30s, 40s, and 50s to really make your wealth grow. And then the fourth area is retaining independence and dignity. That's the ultimate in financial planning. That means we're not going to live off of our kids in retirement. And that's where I'm going to spend most of my time today because that's ultimately what we want to build. Now, we have to approach all 4 of these areas with intention and purposeful effort to build your best financial life. Not the best financial life on your block, not the best financial life among your friends, but the best financial life that you personally can achieve given your resources, your willingness to do things that you need to do, and your objectives and your goals. And all of this, we're doing this with continuing clarity in our finances. Clarity brings control. Control brings intention. Now, the investment, the financial planning process that I use is right here. In the first year, we do all of these things. We go through everything holistically. It takes about 8 meetings, sometimes more, not very often less than that, but so call it 8 to 10 meetings. We got to understand where we're going to go. That's the first thing. No statements, no numbers in that meeting. We just want to know where we're going to go. We're going to assess the current situation. We have to know our starting point. Then we have to project the near future 5-year cash flows and our expected income, expected expenses. Do we need to put a new roof on the house? You know, stuff like that. Then we look at the far future. Now, once we've done all of those things, we have to review because life happens all the time. So each quarter we review a section. Now, this is just my process, but I'm just saying this is a good generic process. You can do this on your own to an extent if you like, but it's just a framework for how to think about financial planning. Independence and dignity. I want to talk about that a little bit more. I said, you know, we won't live off we won't be dependent on our kids. Knowing the path we choose will likely allow us to do everything we want in life. So if we understand what those things are and we lay them out, that's the only way we're going to be able to really plan for them. And as I mentioned before, having clarity gives us control, which allows us to live with intention. So let's take a look at a case. And I'm going to do what I call cash flows for life. That's lifetime cash flow projection. We're just looking at the direction that this family is heading. It's not the actual path they will go because, again, things will happen. But the model allows us to make adjustments, and you'll see that in terms of, you know, well, what if this and what if that? How does that affect us in our older age? So here's the couple, Fred and Wilma. You may know Fred and Wilma. I know Fred and Wilma very well. Fred is 51 years old. Wilma's 47. They have a daughter named Pebbles, who is 18, starting at Cal in the fall. They're going to retire when Fred is 67 and Wilma is 63. Retirement ends at age 100. That's a very nice way of saying they're going to die. I'm going to assume every income and expense grows at 3% per year. And we're just projecting, you know, returns by asset class. We're not projecting the return of every individual stock, and they're each other's beneficiary. We're not worried about that. Okay, so let's see. Here's the income. Fred makes $225,000 with a $50,000 bonus. Wilma makes $160K with a $40K bonus, and then also gets some RSUs. Their living expenses are $200,000 a year. Remember, I said you have to know that. How could you possibly do any projections without knowing what you spend? You got to know what the cost of your lifestyle is. When they get older, their expenses are going to decline, and then, of course, when one passes, it's going to decline even more. Now, they've got other things going on. Well, Pebbles begins at Cal next year. There's no grants, no loans. They're also, the parents plan to pay for her wedding someday. So we're going to throw that in 2029 and give it a cost. And that's in today's dollars, but we're going to inflate that going forward in the model, you'll see. They're also want to do a home remodel. It's a good idea to do a home remodel as soon as the kids are out of the house, right? Make the house more useful. They buy a new car every 4 years. You might think that's pretty often, but realize there's 2 drivers. So each car lasts 8 years. So that adds up over time. We've got to put that in there. And then, of course, health insurance in retirement, have to account for that. This is today's costs for this couple. I've seen higher, I've seen lower, but I think that's a fairly good estimate. And we're going to inflate that as well. They own their home. Believe it or not, the Pebbles or Fred and Wilma's house is on Zillow. You can look it up. Cost value is $800,000, mortgage of $700,000 at 3%. So let's see what's going on with these guys. All right, let me pull a window over here. And that's not what we want to see. Here, let's look at their balance sheet. So let's see what they have. So here's checking accounts, savings accounts, some balances there. They've got a taxable investment account of $125,000. And they've got 401ks. And oddly enough, even numbers. And then there's their home. Here's their mortgage. They do have credit cards and you know, carry balances during the month, pay them off at the end of each month, but no other debt. So all of their savings in excess of their spending is going into their checking and savings accounts and then flowing into their taxable investment account because they've got a cash target. They've got an emergency fund and they've got a cash target over and above that. But everything above that goes into the long-term portfolio. And let's go to the projections. Okay, so here we go. Well, they've got about a little over $1 million. What did we say? They've got I got 245,000 here and 1 million in retirement plans. So it's 1,250,000 here, with a little bit of growth next year, 1,310,000. You can see it grows up. There's a little dip here. That's probably college, buying a car. There's paying for some weddings here. But this is their assets growing over time until they get to retirement. They've got $3.7 million in retirement. Sounds like a lot of money, right? But they're spending 200,000 a year in today's dollars before inflation. So even before inflation, 3.7 million divided by 200,000, that's only 18 years of expenses. That's before inflation. Now, after inflation, and of course, they're going to get some growth by having that invested. You can see the funds go down. Let's see, how many years is that? 2036 down to 2051. So only lasts about 15 years because compounding works in both ways. As soon as you start spending your savings, that compounding of pulling money out works against you pretty aggressively. So now they're out of money. Well, gee, that doesn't work because they're only 81 and 77 years old at that point. And yeah, they've got the house and the house is paid off, but they've got no cash. They've got no money to go buy groceries. So what can we do? Well, we've talked to them and Fred has said he's willing to work for a few years in retirement up to, I believe we said age 75, but he would make a little less because, he wouldn't be doing quite the work that he's doing today. So let's see what that does. Well, that really does extend it pretty well, all the way out to age 92 and 88, but not real happy with that because we're going to live longer than our parents are likely. And not only that, we want some cushion. We want some room. We don't want to die with exactly $1 in our bank account. There's no way we can time that. So that's not really enough. Now, the other thing we noticed is that their investments weren't exactly optimized. So let's get their investment portfolio in a position that's right for them. And so after some risk tolerance discussion and some decision of how to structure the portfolio, this is what we end up. So we changed the taxable investment account and we changed the 2 401ks. Well, that really helped because there's a lot of fuel in this engine, $2-3 million, but the engine wasn't working really well. So now we've got the engine working well and it lasts pretty good, but eventually drifts off as you see how this compounding of withdrawals really accelerates the drop. That's what you're seeing there. And here we go. Well, Fred's already dead. He's at just a dash right there and Wilma's 97. So good for Fred, he lasted, but Wilma's out of money. Well, okay, and they're also, that's still cutting it pretty close. So they're wondering what else can we do? Well, if we cut our living expenses by $1,000 a month, so they're going from 200,000 to 188,000. Look what that does. Now we get all the way out to age 100 for both of them. And before we made these changes, they were going to have to find another $6.7 million. Now they're going to die with $1 million plus owning the house. So a change of 7.7 million. So it's a lot of changes there. Now, I show you this not because these answers are right for you or anybody else. They may be right for Fred and Wilma, they may not. We've got to come to those options though through discussion. And that's where the real planning happens is we try to figure out, okay, what's important to you first? And how do we prioritize what you want to get done in life and what you want to experience in life? And then we build out where you are today, where today's strategy will take you. And if that works, that's great. Then we can come back and optimize and maybe make things even better. But just like with Fred and Wilma, we looked at where they were today, where they were going, and we saw it didn't work. And so we had to go back and say, well, what are you willing to change? What's possible that we can change? And those are the things we came up with. We could come up with many other things. Maybe there's an inheritance that's coming. Maybe there's something else going on in your life. Maybe you're both willing to work in retirement. Maybe we didn't model in any promotions. Maybe you're expecting a promotion. I don't know. We don't want to fool ourselves with the model. We want it to be realistic, but we want that projection to work for us. Now, again, this doesn't mean this is exactly the experience that they're going to have because something else is going to happen in life. And so when that happens, we just come back and plug it in, whatever it is. Let's say Fred loses his job down at the quarry. It's going to take him a few months to find another job and he may not be making as much. Well, let's just model that in and see how that affects him. That takes the quantitative aspects of that experience out of the equation. It allows him to focus on the more difficult part, which is the qualitative aspects of suffering a job loss and getting motivated to go look for another job and realizing, okay, this is the reality of what this means to me from a dollars and cents perspective. So now I need to go out and do things. This is what financial planning is all about. Having the ability to understand the numerical consequences of your decisions in your life. So just to show you what we showed was the base case. Possible adjustments were to optimize the investments. We reduced expenses by $1,000 a month, and Fred work in retirement $80,000 a year. I think I said 70, but $80,000 a year. That's it. That's financial planning. That's the whole of my presentation. I got through it in 16 minutes. Hope I didn't go too fast. If you have any questions, please put them in the chat, put them in Q&A. Would love to address them for you. Looking ahead though, in terms of you and your situation, here's what I suggest you do. You're going to get an email tomorrow with a replay of this video and a link to download the slides so you can look at this a little bit more in detail, a little bit more slowly. Consider which door you are headed towards. Are you headed towards door number one, where you get to do everything you want in life and you die with $1 in your bank account or whatever amount you want to leave your heirs? Or are you headed towards door number two, where you're not really sure if you're going to get to do everything you want? And if you have specific things around that you want to talk about, schedule a call with me. I'm offering, because you attended this webinar, you could schedule a call with me. It's a $300 value for a free coaching session. We could talk about any part of this or any financial topic you want to address. We can take care of it together. I'm going to put the link in the chat here once again. Hopefully it'll come through. There you go. Just click that link and schedule time with me. I promise you there's no cost, of course. There's no sales pitch. I just want to help you because you took the time to look out for your own finances by coming to this meeting here today. Other resources I have out there, I have a podcast called Deliberate Money Moves. Take a look at that. You can always email me with questions, and I do these webinars once a month on different topics. Next month, we're going to talk about how to reduce your taxes, your income taxes in particular. That's going to be on March 4th. You see that there. And in the email you get tomorrow, you'll be able to schedule, you'll be able to register for that. And I always have to say, this is whatever I said here, answering your questions. This is not financial advice. Financial advice should be specific to you and your circumstance and your situation. Do not use rules of thumb. Use your exact situation, use what you exactly want to have happen, and make that happen for yourself. I mentioned the other webinars. Here's the topics here, and always have to show the disclosure disclaimer there. So let me go back to, let's go back to this slide and see if there are any questions. Again, if you have any questions, just put them in the chat or the Q&A. Let's see, I don't see any yet. So I'll give it just another minute or two, and if there's no questions, we'll call it a day. So again, just plug your question there in the chat or the Q&A. Let's see, do you provide referrals to tax accountants? Tax accountants are the most difficult people to find. Yes, I know a few tax accountants. Let me put my email address up there. There's my email address. Shoot me an email. I'll need some information about exactly what you're looking for so I can give you a good referral. Hopefully I'll be able to find somebody for you. So shoot me an email. Any other questions? Don't think anything else is coming through. All right, folks, thanks so much for joining me.